How was real estate this week? That's the question everyone's asking me. And honestly, the answer is complicated, but I can break it down simply. First, I want to give you a quick, simple rundown on what's happening with the mortgage rates right now, because it's the number one thing impacting the housing market. Essentially, they nudged up slightly again over the last few weeks. We saw the average 30-year fixed rate tick up to about 6.26%. Now, while any increase sounds tough, remember that these rates are actually still pretty close to the lowest point we've seen all year, and they're definitely better than where we were a year ago. However, the bigger picture is that rates have been stuck about 6% for quite a while now, and that's why home sales have been moving slower than usual. It simply means people's buying power is reduced, making fewer homes feel affordable. The real drama and the source of all the uncertainty is happening over at the Federal Reserve. You see, the Fed controls a key interest rate that influences what banks charge for everything, including mortgages. For a while, the market was almost certain the Fed would cut this rate again in December, which would be a huge boost to housing. But now it looks like a total coin flip. The officials at the Fed are in a serious disagreement, and that's what makes predicting the next move so difficult. It boils down to two main concerns for the Fed members. On one side, you have the officials who are still worried about stubborn inflation, the rising cost of living that affects everything from groceries to insurance. They think the Fed should keep rates where they are to truly cool prices down. On the other side, you have the officials who are much more worried about the job market. They see slow hiring and think the economy is weak. So they want to cut rates quickly to prevent a bigger slowdown and get things moving again. It's an unusual level of disagreement, and it means the December meeting could be quite contentious, regardless of what they decide to do. So, what does this all mean for us? If the Fed chooses not to cut rates, it means your cost to borrow money for a mortgage, a car, or everything else is likely to stay elevated for a while longer. This is why everyone still feels like life is expensive. We are watching the economic data closely because the job market numbers and inflation reports are the only things that can push the Fed toward consensus. For now, the best advice is to know that we are in a period of high uncertainty and the cost of borrowing money is keeping the housing market competitive, but slow. We are hoping for a clear signal soon. You've probably been hearing a lot of mixed messages about the housing market lately, so I wanted to break down what's actually happening right now. The latest numbers for October just came in, and honestly, it's pretty encouraging. We saw a noticeable bump in home sales across the country, which is a breath of fresh air. The main reason for this uptick is that mortgage rates dipped a bit, sitting at an average of around 6.25%. Turns out that even a small break in rates is enough to get buyers off the sidelines and back into the game. If you're thinking about selling, you'll be happy to hear that home prices are still holding their ground. The median price for a home is now hovering just over $415,000. That is about a 2% increase from this time last year, and remarkably, it marks the 28th month in a row where prices have gone up. This consistency is great news for homeowners because it means your property value is likely staying strong. For buyers, it means you still have to be strategic. But the market isn't running away from you quite as fast as it was during the pandemic boom. We are also seeing some interesting trends depending on where you look. The Midwest and the South are really the busiest spots right now, mostly because there are more homes available at prices people can actually afford. The Northeast stayed pretty flat last month, and the West actually saw a drop in sales. likely because prices there are just so high that it's hard for folks to jump in. Despite those challenges, first-time homebuyers are showing up in force, making up nearly a third of all sales last month. That is a huge improvement from last year and a sign that people are finding ways to make homeownership happen. Looking ahead, there is a bigger economic picture that might help us out too. Experts are pointing out that rent prices are finally cooling down, which helps lower overall inflation. When inflation drops, it gives the Federal Reserve more reason to cut interest rates. That matters to us because when the Fed cuts rates, mortgage rates usually follow suit. So, if these trends keep up, we could see a market that is a little friendlier for everyone as we head into the new year. I have some interesting news for the Florida housing market in October, and it looks like things are moving in a positive direction. Closed sales have gone up, which means more deals are crossing the finish line, and there is also more inventory on the market. That is good news if you've been frustrated by a lack of options lately. On top of that, median prices are actually easing a bit, making it a slightly friendlier environment for buyers. It is worth noting that we are seeing some really big jumps in the numbers compared to last year, but there is a specific reason for that. You might remember the two hurricanes, Helen and Milton, that hit us back in the fall of 2024. Those storms understandably put a pause on a lot of real estate activity last October. So when we compare this October to that one, the growth looks especially dramatic. The experts call this a base effect. But even accounting for that, the market is showing genuine strength. For single-family homes, sales were up nearly 14% compared to last year, and condo and townhouse sales saw a nice bump of about 11%. The median price for a single-family home in Florida dipped just slightly to around $411,000, while condo prices saw a more noticeable drop, landing right at $300,000. This cooling in prices, combined with more homes to choose from, is helping to balance things out after a long period of intense competition. Overall, the market feels like it is stabilizing. Sellers are finding a steady environment to list their homes, and buyers are stepping back in as they see more opportunities and slightly better prices. With the single-family inventory sitting at 5.1-month supply and condos at over 9 months, there is definitely more breathing room for everyone involved. Feels like we are finally moving toward a more sustainable pace, which is something we can all appreciate. If you've been waiting for the housing market to pick up steam, it looks like 2026 might finally be the year we have been hoping for. After a somewhat flat 2025, the experts are predicting a real comeback, with home sales expected to jump by double digits. The forecast calls for a 14% increase in sales nationwide next year, which is a huge shift from the stagnation we have seen recently. It seems like the pieces are falling into place for a much busier market. So if you have been sitting on a fence, it might be time to start paying attention. One of the biggest drivers for this optimism is the mortgage rate situation. While we aren't likely to see those ultra low rates of a few years ago return, the expectation is that they will drift down to around 6%. That might not sound like a huge drop from where we are now, but even a small improvement in affordability can bring a lot of buyers back into the mix. We are already seeing signs of this, with mortgage applications up significantly compared to last year. People want to buy, and as rates ease up just a little, they are making their move. It's important to note that while sales are expected to rise, prices aren't predicted to fall. In fact, home prices are forecasted to go up by about 4% in 2026. This is largely because there is still a shortage of homes on the market and job growth remains steady. So, while we are looking at a busier market, we're also looking at a stable one where your investment is likely to keep growing in value. We definitely aren't in danger of a price crash, which should give both buyers and sellers some peace of mind. However, the market is still a bit of a mixed bag depending on who you are. Repeat buyers and those with equity from a previous home are doing well, often dominating the market with cash offers. On the other hand, first-time buyers are facing a tougher road, with their share of the market dropping to historic lows. The good news is that if you are selling, this means there is a solid pool of qualified buyers out there. And if you're buying, just know that while competition is heating up, the opportunities are growing too. If you've been feeling the pinch in your wallet lately, you're definitely not alone. A recent survey from Florida Atlantic University found that a huge chunk of Americans, about 89%, are worried about inflation, and nearly just as many are stressed about housing costs. It makes sense, right? With everything from groceries to healthcare getting more expensive, it's no surprise that many folks are living paycheck to paycheck or even thinking about moving just to find a more affordable place to live. But here's the really interesting part. Despite all those financial hurdles, the American dream isn't gone. In fact, more than half of the people surveyed still believe it is alive and well today. Floridians in particular seem to be holding on to that optimism a little tighter than the rest of the country. Even with the daily challenges of debt and rising prices, there is a strong sense of hope that things can and will get better. Looking ahead, that resilience really shines through. Most people still feel confident that their standard of living will improve in the next few years. There is even a majority who believe that future generations will have a better life than we do now. It is a powerful reminder that while the economic road might be a bit bumpy right now, that core belief in opportunity and a brighter future is still very much part of who we are. You might be surprised to hear this, but fewer people are regretting their home purchases these days. Back in 2023, about 15% of buyers felt they overpaid for their new place, but that number has dropped to just 8% this year. It seems that because the market has slowed down a bit, buyers finally have the breathing room to really think things through instead of rushing into a decision they might second guess later. In fact, nearly 40% of recent buyers say they have absolutely no regrets at all, which is a big improvement from a couple of years ago. Of course, not everyone sells through without a hitch, and the challenges seem to depend a lot on your age. Older buyers, like boomers, are feeling pretty good, with 60% saying they are completely happy with their purchase. On the other hand, younger folks like Gen Z and millennials are finding it a bit tougher. Their biggest headaches tend to be unexpected maintenance costs and draining their savings accounts faster than they anticipated. Gen Z buyers, in particular, mentioned they sometimes skipped inspections or underestimated the day-to-day cost of owning a home, which is a tough lesson to learn. The big takeaway here is that the frantic pace of a seller's market we saw recently has cooled off, and that is actually a good thing for you if you're looking to buy. With homes sitting on the market a little longer, about 2 weeks longer than before, you have more time to weigh your options and make a choice you feel confident about. While affordability is still a hurdle, it looks like taking that extra time to plan and inspect is paying off, helping more people feel settled and happy once they finally get the keys. I have some encouraging news if you're currently renting but dreaming of having a place of your own one day. New report just came out showing that nearly half of all renters believe they will be ready to buy a home within the next 4 years. That number jumps even higher to about 67% when you look just a bit further down the road, say 8 years from now. It really shows that despite the hurdles we hear about, the dream of homeownership is still very much alive, especially for younger generations like Gen Z and millennials, who are feeling pretty optimistic about making it happen soon. Now, I know it's not always an easy path. The biggest roadblocks people mention probably won't surprise you. Saving up for the down payment, how home prices, and worries about credit scores. In fact, more than half of the people surveyed said a low credit score was a major concern for them. It is also common to feel a bit lost when it comes to the financial side of things, with many folks admitting they could use a clearer understanding of how mortgages actually work and what they can realistically qualify for. The good news is that the industry is starting to catch up and help bridge that gap. There are new credit scoring models being approved that can actually take your rental payment history into account. This is a game changer because it means all those rent checks you have been paying on time could finally help you qualify for a mortgage. So, if you are renting now but want to buy, just know that you are not alone. And there are more tools and resources becoming available to help you turn that goal into a reality. Now, despite all the talk about high interest rates and shaky employment numbers, Gen Z is actually rewriting the script on homeownership. The oldest members of this generation are in their mid to late 20s now, and believe it or not, they are buying homes at a faster rate than millennials or Gen X did at the same age. It turns out that over 20% of these young adults already own their own place, and they are doing it by being incredibly savvy and creative with how they enter the market. One of the biggest ways they are making this happen is by really doing their homework on financing. Instead of just accepting standard terms, they are taking full advantage of programs designed to help first time buyers. I'm seeing a lot of them utilize FHA loans that allowed for much smaller down payments, sometimes as low as 3.5%. They're also finding grants that provide cash for closing costs and using federal tax credits that help lower their monthly payments. For a generation that often deals with student loans, finding these specific programs is often the key difference that allows them to stop renting and start owning. Another smart move they're making is going straight to the source for deals by negotiating directly with home builders. Builders want to move inventory, right? So they often offer incentives that you can't get from a traditional seller. Gen Z buyers are locking in lower interest rates through builder preferred lenders or getting help with closing costs. They are also willing to shop around for the best financing deal, which is a simple step that can save thousands of dollars over the life of a loan. Yet, so many people skip it. Family and community support is playing a huge role here as well. It's becoming very common for these buyers to accept a bit of a help from parents for down payment or even to use inheritance money to get a foot in the door. Some are even teaming up with friends or siblings to co-buy a property, while others are moving back home specifically to save up cash. Instead of trying to do it all alone, they're leveraging their relationships to build equity sooner rather than later. When it comes to the actual houses, this generation is very practical. They're gravitating toward new construction because modern homes are more energy efficient, which saves them money on utility bills and unexpected repairs. They're also looking outside of the most expensive major cities and planting roots in more affordable areas where their dollar stretches further. They aren't trying to impress anyone with massive mansions. Instead, they're buying smaller, manageable starter homes and planning to stay in them for the long haul. By aiming to stay put for over 15 years, they avoid the costs of moving and trading up, which is a brilliant long-term financial strategy. And for those who have recently bought a home, here is a bonus tip. Because making your mortgage payment should never be stressful. As a real estate agent, I see that the clients who set up the best payment habits right from the start are the ones who feel the most confident about homeownership. Getting your payment in on time every month is one of the absolute best things you can do for your overall financial health. It builds equity in your home faster and keeps your credit score looking great, which is vital for everything else you want to do. So let's talk about the practical options, because you want this process to be as simple and foolproof as possible. The method that works best for most people is paying online. Just about every mortgage servicer now has a website or a dedicated mobile app that lets you log in and submit a payment quickly and efficiently. It's usually free and it puts you in a complete control of the timing, meaning you get to pick the exact date you want to pay. Plus, you get an instant record confirming that transaction is done. The only downside here is that it requires you to remember to log in every month and manually click the submission button. If you know you're the type of person who might forget to log in, then the easiest path is definitely setting up automated withdrawals. This is when your lender automatically pulls the payment straight from your checking or savings account on a specific date each month. It truly takes the mental load off your shoulders, virtually eliminating the risk of missing a payment. The one thing you have to be careful about is making sure you keep enough money in that bank account to cover the payment. If the money isn't there when the payment pulls, you could get hit with some pretty hefty overdraft fees. On the positive side, if you want to pay your house off faster, automated systems often make it simple to set up a bi-weekly payment plan. Now, you have a few other options, but they all come with some big catches. Sometimes people ask about a credit card to earn points or rewards, but honestly, you should probably forget about it. Most mortgage companies do not accept credit card payments for the monthly bill. If you find one that does, they almost certainly charge a service fee that is high enough to completely wipe out any rewards you might have earned. It's generally just not worth the hassle. You can also pay over the phone, which is useful if you're running right up against the due date and need to make sure the payment is credited quickly. You just call the customer service line with your account and bank information ready. However, just like with credit card payments, you need to ask first, because many servicers will charge a small fee for the convenience of taking your payment this way. The final and most traditional option is mailing a check or paying in person at a local branch. If you mail a check, you have to factor in the time it takes for the mail to arrive, and then the time it takes for the servicer to process it. Furthermore, paper checks are increasingly a target for fraudsters. If you pay in person, you might need to use a money order or a cashier's check, and those often have limits or extra steps. Honestly, between the potential for mail delays and the convenience of modern technology, electronic payments are simply the most reliable and convenient way to handle your mortgage these days. Just a quick final note, if you ever have extra cash, you can significantly reduce the amount of interest you pay over the life of the loan by paying down your principal faster. You can do this by paying bi-weekly, making an extra payment every year, or just adding a little bit to your payment each month. The most important thing here is to clearly communicate to your servicer that the extra money must go directly to the loan's principal balance. Also, check your loan documents for any mention of a prepayment penalty, just to make sure you won't get charged a fee for paying your mortgage off ahead of schedule. And that wraps up this week's look at what's really happening right here in the Florida and the US real estate market. Don't let the headlines scare you. Knowledge is power when you're making a move. If you want to stay ahead of these trends, make sure you hit that subscribe button and ring the notification bell so you never miss an update. I'm Albert Stepniak, a realtor with Coldwell Banker here in beautiful South Florida. If you have specific questions about your property or you're ready to start your search, my contact info is in the description below. Thanks for watching, and I'll see you in the next one.